realized 50, 75% more than what they initially might have been willing to sell for, which in this world, I mean, I'm talking going from 10 to almost $20 million, something like that. So when I meet with a business owner who's thinking about selling his business, what I typically ask first is, what have you done to prepare for the sale? And that's a loaded question because they're not going to know exactly what the answer to that is. And what I'm asking about is, do you think you know how much your business is worth? What is the state of your books, records, and financial statements and processes? And who is available in your company to take over and run it if you step aside as a result of this process? So we often talk to our clients about building transferable value, meaning value that doesn't rely on the business owner to remain in the business. It's not all up in his head or her head in terms of who the clients are, the relationships of the business, how the sausage gets made. The processes exist within the business. There's a team there that's able to run it, regardless of whether or not the owner is there to assist. So what I always say is, I wish you'd come to me sooner rather than later. I don't want to react when you have identified a potential buyer, you're engaging in discussions about what your purchase price will be, and we're at the letter of intent stage. By that point, we might have missed the opportunity to put a nice new coat of paint on your business, get everything really ready so it's looking great, and do some estate and wealth planning that may be necessary as a result of this process, because presumably the business owner is going to come into one of the largest pots of cash that they're ever going to see in their lifetime. And knowing how that's going to be transferred on to their family members is prudent. It's just a smart way to proceed so that we know how, we have everything ready. We have everything ready to go. Moreover, private equity firms, which is, I would say that it's one of the more common exit strategies that we see, is that one of our clients might get acquired by a company who's doing a strategic acquisition, and that company is backed by private equity. Private equity is giving this company money to go out there, buy similar companies so that they can build either a larger geographical footprint or add service lines and business lines to their business to grow revenue and make the business more attractive for a future purchaser. Private equity, when they look at a business, is going to want to see clean financials, strong management team, strong processes that are already in place. That makes your business's value unassailable in terms of how they're going to make their offer, and when due diligence, what happens often is that during the due diligence process, what a client feels like is an awesome, squeaky clean business is revealed to have some problems with it, and that affects the value, that affects the dollar negotiation with the private equity firm. However, that's not the only avenue in terms of who might be a potential buyer. I have a client right now that looked at the market, talked to some private equity firms, didn't like what they saw in terms of what the private equity firm was bringing to the table, and pivoted and decided, hey, I think that a private equity firm might come in and I wouldn't say ruin the company, but not run it in the way that I want it run. They're going to destroy my legacy or obscure my legacy, and the culture that I've spent 35 years building is going to disappear. I'm going to go another way. And we've started to transition or just have discussions about transitioning the business to senior employees and management. But if you don't know how private equity works, using this scenario where a private equity backed business is buying up related businesses in different geographical areas or adding lines of business, what they're trying to achieve is a growth in revenue. At a smaller revenue number, the multiple that a private equity firm would pay for the business, we'll say, is in the range of 4 to 6%. I'm talking under 10 million in total revenue and EBITDA. As you grow the revenue and EBITDA, which is net profit or free cash flow, the multiples start to go up. 4 to 6 becomes 6 to 8, becomes 8 to 10, such that as a business gets up to 30, 50 million, they might be paying 10 to 12 to 14 times EBITDA at that point. The more revenue and EBITDA they can bring together, when they sell the business on, they will achieve those multiples. So if they're buying your small business, if they're buying a bunch of small businesses at a 4 to 6 times multiple, and when you add them together, it results in a larger company or a larger group of companies with a larger total revenue and total EBITDA, then there's the built-in margin that they're trying to achieve. They're going to sell a bunch of businesses they bought for 4 to 6 times at 10 to 12 or 14 times EBITDA. So with that in mind, you can see that a lot of private equity firms focus on growing revenue and growing EBITDA, which often means cutting costs, which means a lot of pressure on the people that are left behind to hit the targets and hit the numbers. These are professional financiers and bankers and business people that are going to bring, I would say, discipline and order to a business that might not otherwise have been accustomed to it. And that can affect culture sometimes as well. We've seen that happen as well, where within a year or two of a private equity firm acquiring a business, the culture is not at all what the original owners had in mind. That doesn't always happen. It's just kind of what people hear, I think, and it's somewhat true that can be an adverse scenario that comes out of the process. There are rules of thumb that govern the step up in multiples. I wouldn't want to generalize it too much because it can be very industry specific. A professional services firm versus a manufacturing firm, the step ups are at different locations and based on different multiples. And certain industries are particularly hot. When an industry is hot, the rules of thumb go out the window. They want to buy up as many data centers as they can, for example, or whatever it be, and they'll pay 10 times, 12 times. That's when you get into bidding wars and figure out, that's where an owner can maximize the sales opportunity. In order to maximize that sales opportunity, the owner needs to have prepared and engaged appropriate professionals to help them get their business ready to market, identify the market of potential buyers, and with a little effort, attract the buyers to a situation where there's now a market for this particular business and there's competition among the buyers to see who will pay the most. So many times when we're reactive to clients, hey, I've got a letter of intent in hand. This group wants to buy my company. Okay, that's great. I'm glad you're excited about it. But do we know that that's the best offer that you could get? Are there other interested buyers out there that we might want to say, hey, look, we're about to sell, but if you want us, come take a look, and we can create that opportunity to achieve even a bigger purchase price for the potential seller. And so many of our clients do not want to engage those advisors to help with that. There's a cost to that, of course. That can be, the mergers and acquisitions advisory firms who would run that process want to get paid for their services, and that's money that's coming off the purchase price at the time of sale. However, in a lot of cases, I see that they bring more value, enough extra value to the transaction to justify that expense. I mean, if their fees, I'm just making up numbers, but if it's a $10 million deal and their fees are 5% of the purchase price, $500,000, you're like, oh my gosh, that's a big chunk of the money. But let's say they got involved at an early stage and the original purchase price was 8. What in theory, what they should be able to do is bump that price up, more than cover their fees, and you're still getting, or the business owner is still getting a nice extra rate of return on their investment. We have seen some clients who did everything just right. They got engaged in the process early. They figured out, they knew their business was hot and growing, marketed it at the right time, had it facilitated by professionals who understood how to maximize the transaction value, had multiple private equity backed companies bidding for their company, such that we saw the purchase price go up by increments until finally a winner emerged, and realized 50, 75% more than what they initially might have been willing to sell for, which in this world, I'm talking going from 10 to almost $20 million, something like that. And an example of when I saw that particularly in the distant past was around the time of the dot-com boom. Everybody was buying up new internet-based retailers that were first to market in a particular niche, and they got there first. They became the leading name in that industry on the internet for selling that type of good or service, and boom, one of my clients just exited perfectly. It was amazing. One particular example is that I had a client in a North Georgia community, was among the largest employers in that county, had 3 or 4 different locations there, a number of employees, and was unsure whether the prospective buyer was willing to stay there, whether they were going to close down a couple of the places, move operations to somewhere else. And so, notwithstanding the fact that they probably would have been able to get additional money by getting a prospective buyer to agree that, hey, they're going to stay here. They signed long-term leases. We had other assurances that they were going to stay, keep people employed, stay in that community. The client was pleased with that. Now, you can't force somebody to stay forever, but given that that was one of the premier objectives, that was something we really worked hard on getting as much as we could from the prospective buyer on. You are not going to close down any of these places and put people out of work.